You're listening to the Goldnomics podcast, with new episodes every month on iTunes, YouTube and SoundCloud. Subscribe to stay informed. Hello, Happy New Year, and welcome to episode 10 of the Goldnomics podcast, where we're looking forward to 2019 to see what it brings. And we're asking the question, are we about to prepare for a global debt bubble collapse in 2019? As ever, I'm joined by CEO of Gold Course, Stephen Flood, and Director of Research and Marketing, Mark O'Byrne. And as ever, I just want to remind everybody before we get into this to subscribe to our podcast on iTunes, subscribe on YouTube as well, hit the notification bell so that you're updated every time that we release a new video. And you can also catch us on SoundCloud as well. But now to the question at hand, what has 2019 got in store for us? And are we expecting potentially a global debt bubble collapse? Mark, if I can come to you.
Yeah, it's a bold call, and as ever with these bold calls, there's real risk that you can be proven wrong, particularly in the short term when you put time frames on such as 12 months, and 12 months is a very short time frame in the span of history. But I think there is quite a good possibility that this global debt bubble that we've been talking about in recent years, I think we're already seeing that bubble being lanced, and a few little pins have gone into it. And I think, yeah, there's a good chance that if it doesn't burst in 2019, that it will burst we'll see the signs of it bursting in 2019 and burst in the coming years. So it's already in credit markets in the US just in the last few days. There's a lot of issues developing there, shall we say. And the leveraged loans market, there's a huge amount of redemptions, and there's people warning about it. Janet Yellen, the ex-Federal Reserve chairwoman, the Bank of International Settlements, which is central bank, even Greenspan came out yesterday warning about not so much the credit markets on the debt side of things, but just warning about the investment markets and how investors should run for cover, is what he said. So, yeah.
And we just saw as well, the Federal Reserve increasing interest rates. And not only did they increase interest rates, but they kind of set their stall out saying that in 2019 there's more to come as well.
Exactly, and I don't think that's likely given the reaction we've already seen in stock markets, and it's quite unusual normally around Federal Reserve interest rate decisions. Even in the recent rises of interest rates we've seen in recent months, stock markets have tended to react quite positively, but we've seen a very poor reaction, shall we say, overnight. Big sell-offs of stock markets globally. Gold has performed quite well. It's gone up 1%, and I think already there's a lot of indicators. Just yesterday, FedEx Outlook, and FedEx is a really interesting bellwether for the health of the global economy, you know. And FedEx Outlook they basically reduce it quite significantly, you know. So and that's just one sign of many signs that the global economy, the US economy, the Chinese economy, and the global economy are slowing down. So I don't think the Federal Reserve will be able to increase interest rates because of the scale of the debt, both in the US and globally.
And Steve, what do you think? Are we expecting, are we due to expect a global debt bubble collapse in 2019?
Yeah, I would agree with a lot with what Mark said there. The debt levels have been incredible. You know, the corporate non-financial debt now has increased tremendously over the last 10 years. You're looking at quite a large debt profile inside the energy industry as well in the States. And with oil prices under pressure right now, there's a lot of concern that covenant light type lending or junk bond lending is going to have a knock-on effect or potentially a contagious effect within the markets. So there's quite a bit to be concerned about. And also, I think globally you're looking at China, who's taken on an enormous amount of debt in the last few years from a very low base to about, I think it's around 40% of their GDP now in terms of their central bank balance sheet has grown. And so it's very much unsustainable, and it looks like they're going to be, if in a rising interest rate market environment, those who have extreme amounts of debt will find their balance sheets going upside down very, very quickly, and the credit rating agencies will adjust their rating of these entities accordingly. So it's very, very worrisome.
And sorry, you said they're in a rising interest rate environment. This is a question to either of you or both of you. I mean, currently, what are we expecting from interest rates in, say, in the US, the UK, and in the euro as well over the next 12 months? What's priced in at the moment? And do we actually think that they're going to be able to deliver on what's expected?
Well, I know the obviously this is a conversation that's been happening in the last few weeks, and the market has the general broader market in the States has been quite anxious about what the Fed will do in this particular meeting. They did raise, but they also gave guidance that they'd be a bit more sensitive for the future. They still want to raise rates, but they might do a little less so. And in doing so, they've kind of thrown the market a bone. The market hasn't sold off aggressively. They've kind of accepted that. It's important that obviously the monetary authorities are seen to be independent of the markets and politics. And I don't think anybody really believes that to be the case. That there's always significant pressures on them, and I think in this environment those pressures are going to increase because if we do have a contracting economy and unemployment rises, and those anxieties that we're seeing politically will probably increase quite a lot, and there'll be more pressure put on the Fed maybe to stall those rates. And who knows, they could start another quantitative easing campaign as well, and create further bubbles in the future. I'm not so sure that they can normalize as much as they want. They want to get rates up higher, 4 or 5%, so that they have some sort of firepower in which to dampen any kind of contraction in the future. They're at a very low base. In the previous recessions, they were able to drop rates by 4 and 5% in order to create support support for the markets.
They're kind of in a catch-22 situation, though, aren't they? Because it's effectively, they want to increase rates so that they can drop them.
Exactly.
If they need to.
Yeah.
But the process of actually increasing rates could potentially cause the thing that they're trying to eventually solve.
Yeah, it's like a drug dealer. They're trying to wean off the low interest rate environment that's been there for 10 years plus, artificially low, and as a result now, I would suspect, as many others would, that we have quite a lot of misallocation of assets and capital right throughout the economies of the West, and that these companies that are poorly run with leveraged balance sheets and lenders who have lent money on very poor terms, covenant light as it's known, will be found out very, very quickly with rising interest rates. So can they kind of do a controlled burn and raise rates slowly without killing the golden goose? Many would think that they probably can't. And whatever they do in the States for their own domestic reasons has a knock-on effect on the global dynamic as well. And so places like Asia may actually be where the straw breaks the camel's back. I know I've given you loads of anecdotes there, but they're the best ones I could come up with.
Or just on that, I think most of the major central banks have said that they're going to increase interest rates in 2019, but only by small amounts. And I suppose the question is, as Stephen rightly said, are they capable of doing it, given the debt challenges that are out there, and the fact that the economies are already slowing down, because debt is it's throughout every level of society, every strata of society, from the consumers, households, into the businesses, the corporates, the banks, and obviously in the sovereigns as well now, because the sovereigns bailed out the banking sector in particular. So it's that basically we're heading towards a quarter of a quadrillion. So that's the new word that we're going to be hearing about more in the coming months and years, a quadrillion.
How many zeros is that?
A good question. I think it's 15. I'm going to have to think about that for a second, but it's nearly 250 trillion. So 12 zeros in a trillion. So exactly 15 zeros. So it's just absolutely humongous. It's three, and it's what's important. People say, oh well, that's so us. Sure, who do we owe the debt to? We all owe the debt to each other on this little planet Earth, But you have to look at it relative to the GDP and to the goods and services that we all trade. The 7 billion people on this little planet, and it's now heading towards 320%. So the total debt is more than 3 times the value of all the goods and services that we trade on the planet, and it's increasing very significantly. So, and it's a huge number. I think we lose sight of it. We work in financial markets and we deal in big numbers every single day, in millions, but we used to talk about billions, and then trillions, and now we're talking about quadrillions. And I said it's basically 1 trillion. If you we're coming to Christmas now. It's Christmas time, and we're celebrating the birth of Jesus Christ. So he was born, whatever, 2019 years ago, or was it 2018 years ago? I always get that mixed up. But anyway, it's nearly 2020 years ago he was born. If you multiply that by 365 days, you could spend $1 million every single day since the day that Jesus Christ was born, and you would still have not hit $1 trillion. Right. So that's the scale of what we're talking about here. It's just absolutely humongous, and people lose sight of that because I suppose we're just bamboozled by figures, and plus because the central banks have been cheerleading this economic recovery, and they're downplaying the risks of the quantitative easing and the amount of debt that they've actually facilitated this huge global debt bubble by keeping interest rates as low as they have done in recent years. So they have been the cheerleaders, aided and abetted by obviously the bankers and the brokers and Wall Street and the City of London and the usual suspects, and this whole recovery narrative that they've created in recent months and years. But the recovery is very, very shaky indeed, on very vulnerable ground, and it's not sustainable.
And it's been driven by the quantitative easing. It's been driven by the liquidity that the central banks have been pushing into the market. And as that comes off, we can see effectively some of the effect of that coming off in the stock markets. Now, I know we haven't had a crash. Stock market crash, but we have seen nearly 3,000 points off the Dow Jones at this stage. I mean, we're looking at bear market territory on this, aren't we, Steve?
Yeah, I mean, we are, but like, what was it when Trump came to power in late 2016? Was it? He was at 17,000. Am I correct? Or thereabouts. So. We're at the tail end of a cycle where the markets were going like a hockey stick. So
you see that run up to 20 to 26 as a kind of a parabolic spike, yeah?
Yeah. I definitely do. I mean, it's broken all records for length of bull market, and but it's also very much focused on a number of stocks. It wasn't felt around the world in other global stock markets. So I think that the market could fall an awful lot more before it actually has a kind of a major impact on the broader economy in people's in the real world. But it's an evolving story. I think in 2019 what we're going to be looking at with the stock market is if they get another 1 or 2 interest rate rises in, I think you're going to see some banks around the world coming under pressure. You could be that Deutsche Bank one everyone's looking at, but it could be somewhere else. It could be in China. It could be a hidden bank in China that blows up with like a star going supernova. There's just so many unknowns under the surface, and I think this is going to be interest rates so low for so long, and then you turn the cycle, and you have a yield curve as well that's inverting. I know I'm getting technical there, but there's quite a few things happening, and I think the stock market is important, but it's not as important as the debt markets. That's where you want to watch out. The balance sheets of these big companies, big banks, big national champions, and we're going to see, just like Buffett said, when the tide goes out, and that's when interest rates go up, you see who's swimming naked, and that's what we're going to see in 2019.
Mark, Steve just mentioned there, you talked about Deutsche Bank, and that's one that you've been talking about for a little while now. Will you just probably expand on that? What is the issue there, and rather than just the issue, what's the potential impact for markets?
Well, so the issue is it's the biggest bank in Europe, biggest bank in Germany. They're a very large systemic bank that lend to a lot of other big banks around the world, and they are a bit bigger than Lehman in many ways, and they are borderline insolvent. And there's talk to the German government is there's no talk, actually, it is happening. But it's funny, the media is barely reporting it, and it gets picked up in the specialist media in Bloomberg and that, but it doesn't seem to be getting into the mainstream media at all, So the German government is actually going in and doing looks like they're going to do a forced merger between Commerzbank and Deutsche Bank, and they wouldn't be doing that unless the bank was in significant difficulty, So they've basically, like a lot of banks, they've massive debt, and they also have just one of the biggest derivative books in the world, and massive derivatives exposure as well. So
they're a massive counterparty for a lot of other banks, but they're also a massive liquidity provider into the market as well. either facilitating it through clearing systems.
Yeah, yeah. And that's what
eating their own.
the BIS warned about this week, that some of these giant liquidity providers themselves, if they get into difficulty, then the whole system blows up again, as it did after Lehman. And
Because we had a massive liquidity crisis after Lehman in the 2007 2008, and it was the lack of liquidity in the interbank market that then triggered basically the global financial collapse. So you're saying that Deutsche Bank is one to keep an eye on as a potential cause of another financial or liquidity crisis?
Potentially. I mean, the German government, they're being proactive in this regard, and the Germans are smart, obviously, and they seem to be getting ahead of it. So maybe it won't be Deutsche Bank, but there's lots of other banks around the world. Even some of the UK banks were obviously bailed out by the UK government, and some of them have significant issues. And Brexit is possibly not going to help them in any way. And also some of the Irish banks have, all these banks are interconnected and interrelated, and they've all lent each other, and this daisy chain of risk, and that's what creates the whole systemic risk, that if one of the larger banks goes down, then it takes some of the other larger banks, and then the smaller banks are obviously even more vulnerable, So and there's Italian banks, big Italian banks as well. I've mentioned Irish banks, the whole so-called pigs, the periphery nations in Europe, the Portuguese banks, Greek banks. I mean, they've all been put on life support by the ECB, and now that life support, they're talking about taking away. Mario Draghi came in with his bazooka, and he gave all these banks a lifeline. But as we all know, they kicked the can down the road. No one's using that term anymore. Kick the can down the road. We all used that term 5-10 years ago, and now we've forgotten about it. But now we're coming towards the end of the road, and the ramifications of these insane monetary policies and the giant Ponzi experiment that we've been engaged in for the last 10 years. I think it's going to come home to roost, and we've seen that already in 2018. I think we're going to see more of it in 2019, should I say.
Yeah. Now, you mentioned there Brexit, and I suppose no discussion about 2019. The outlook for 2019 would be complete without us spending some time talking about Brexit. I mean, at this moment in time, the whole thing looks like an unmitigated disaster. It doesn't look like this deal that Theresa May is proposing is going to get passed in any sort of parliamentary vote. And now we've got the UK and other countries talking about the preparations that they're making for a no-deal Brexit. I mean, a no-deal Brexit, it has to be one of the biggest risk factors for Europe. Ourselves here in Ireland, obviously for the UK, but for Europe as a whole, and which will have global implications.
Yeah, I think it's a bigger risk for Europe than it is as a whole than it is for Britain itself, in many respects, because it sets a precedent for other countries. If they get escape velocity and they're able to pull themselves out of this and use the Commonwealth and trade really, really well and in 2 and 3 years, then suddenly it becomes like an alternative for any disgruntled European member.
That's a big if, though, isn't it?
Yeah. Well, I'm telling you, I think I've said it once or twice before. It's for me, Brexit is more about European cohesion and the lack of accountability at the heart of Europe. A lot of people have frustrations about that. I think British people have a very particular form of sovereignty that they cherish, and they've reacted first. And at these feelings of anxiety, it makes it makes an awful lot. It doesn't make any sense from an economic point of view, from a trading point of view. You're losing access to one of your biggest markets. You're making it very much more difficult to buy from and sell to. But my long-term prediction for that is that the nation of shopkeepers, they weren't called Great Britain for nothing. They did rule large portions of the known world for a very long portion of time, and they did it from a small island on the side of Europe. I wouldn't count them out. I think that they've got it. There's going to be a round two, and it's going to be really tough for the next 3 or 4 years. If it's a messy exit or if it's an organized exit, I think it's going to get ugly. But they will adapt. I think.
But I don't think I'd be back in that pony, if I'm honest. And,
no, not short term. Short term, no.
Whatever. Could be a mess for 5 or 10 years.
Yeah, but I mean, whatever the mess that would be created by Brexit with a deal, the mess of crashing out with no deal has to be many times worse.
I know where Steve's coming from, and I share his view to a degree that I think the UK, in the long term, 5, 10, 20 years, it may be in their interest to disentangle themselves from the EU because of the issues that there are in the EU, and the move towards this giant superstate, federal superstate that very few people want. But at the same time, I think that no deal Brexit will be contagion for everybody, and I think it will impact both the European Union, as Stephen is rightly saying, will impact Ireland quite significantly, and it will impact the European Union, and the UK's major trading partners are in Europe, I think it's classic contagion, and it will be very bad for all of us. But no, what's interesting is we're all now talking about the risk of this. It was downplayed by the media and the experts for a long period of time. Now we're saying, actually, unfortunately, it looks like there's a good chance of this no-deal Brexit. And no one is talking about, or very few people are talking about the actual ramifications in terms of investment-wise, and what that will do to stocks in the UK, in Ireland, in Europe, what that will do to bond markets, as Stephen alluded to before, where the real risk is in the bond markets in the UK, gilts in the UK, what will happen there, the FTSE is an interesting one because it has a lot of international exposure, so it's a little less exposed. But UK gilts very exposed, European bonds very exposed, and then obviously the euro and the pound very, very exposed, and obviously we're seeing that already in 2018. Gold has gone up in sterling terms and in euro terms this year.
I mean, the expectation is
gold has already begun to price in risks.
Yeah, the expectation is, though. I mean, obviously the sterling has sold off for the last while, and things are not looking good for sterling at the moment. But I mean, if we do see them crashing out, a no-deal Brexit scenario, we're going to see significant sell-off in sterling, then, aren't we?
Yeah. Well, we already have done.
But even more. I mean, crisis stuff.
You would see even more, yeah. But then I think, as Stephen said, it has big ramifications for the EU as well, because if it happens, then obviously it's more likely that the Italians will follow. And there's a lot of, even the French are not as pro-European as they were before. We see this yellow vest movement. You just don't know where these populist movements are going to go. So, the Spanish, the Portuguese, the Italians, the Greeks, the Irish, none of them are huge fans of this federal EU superstate project that the bureaucrats are pushing for and have been pushing down people's throats. So you're right. I think it will create risk to sterling in the short term, but I think in the medium term, next year, 2, 3 years, people will step back and say the euro itself as the common currency, the single currency is arguably more vulnerable than sterling in the medium and long term.
So I can just to come in there. I mean, one thing my timeline there was the medium to long term, 4 to 5 years out. I think it might work out quite well for the UK if they manage it correctly. And I do think they have the depth of trading experience and creativity to pull themselves out and make the most of whatever comes. I'm just calling it. I know a lot of people over there, and I've dealt with them a long time, and I think they're a very canny bunch. I know you have too, Dave.
I'm not as confident, but I just want to say one thing to say though.
I am in a longer term, not 5, 10 years, but maybe 20, 30 years, maybe. Yeah.
But I think this idea of crashing out with no deal, right? I actually don't think that it's going to happen.
No, I don't. I agree.
I think it's being used as leverage. Now, I'm not too sure at this moment in time. I've always long stated that I believe that there'll be a second referendum, but I do believe that the no-deal Brexit at the moment is being used as leverage. I just haven't decided whether it's
high stakes poker. Yeah.
Whether it's leverage to say, listen, guys, we've got to get a deal through because any deal is better than no deal at all, or whether it's leverage to say, there's a very strong chance that we're going to crash out with no deal, so let's go for a second referendum. So I don't think that we're actually going to see a situation where they crash out. I think it's just being, that leverage is being used, and it's going to be a little bit of brinkmanship, and I don't know whether it's the get the deal across the line or whether it's the second referendum is going to be the winner at the end of the day.
I think there's going to be a bad deal. It's going to be some deal. It's going to be a pretty ugly looking thing. It's going to be, knitted together in the last minute, and it'll limp through. It'll maintain, the connections with the insurance market, the foreign exchange markets, which are huge for the global infrastructure, financial infrastructure, and there'll be something on trade goods back and forth. But there's going to be an awful lot of upset and uncertainty, and it'll impact GDP right across the region for a year or two at least. But I do think if in this scenario, and I do think it's not the likely scenario, but if it's a no deal, like shutters down situation, then you're going to find Irish banks and UK banks under significant risk.
Mm.
And the thing that many people, and I was just talking to a financial advisor yesterday, who has a few hundred clients in Ireland, and he had no clue about bail-ins. Now, our listeners and our clients, most of them know about bail-ins, but most people don't. And essentially, what it is basically the ability for the government in a bank resolution to fix a bank that's in trouble. They can now go in and confiscate the deposits of people and savings of people and companies, and use that to recapitalize the bank so the bank can survive at the expense of the saver. Now, I'm a capitalist. I think that's probably the worst thing you can do. Depositors should partake in a bank resolution. They should be punished if they've put their money with a risky bank. But this could be on a systemic level. So even good banks could go bust, and these monies could be taken out and used to recapitalize the bank. And I think people need to be very aware of that, and they need to probably reduce their exposures, the excess savings that they have, and consider alternatives to that. And obviously we believe in gold, but they should also look at keeping money in safe jurisdictions, in multiple banks, in multiple jurisdictions around Europe and elsewhere in the world. And I think that needs to be done fairly quickly before any kind of monetary measures are brought in to protect currency flows in anticipation of a negative Brexit. And I expect those to come in. I mean, if I was a minister in either the UK government or the Irish government or a near European government, I would be bringing in currency controls right now to stop that from happening.
Well, let's have a talk about what's going on in Washington, D.C. at this moment in time. I mean, we're seeing a lot of previous Trump administration and connections being indicted. And it seems like that there's a kind of a net closing in around Donald Trump as well. Would you agree? And ultimately, where's this going to lead to? I mean, we're looking at potential impeachment proceedings for the president of the United States in 2019, do you think?
Yeah, it's possible. It's possible given the crazy things that are going on over there, and I think there's risk to Mueller as well. Because it's similar to the Brexit thing. It's very high stakes brinksmanship, but seeing these two very just extremely polarized enemies in effect, and these people should be allies, and when the respective countries they're almost sworn enemies, So I think Trump is Mueller himself is vulnerable, and Trump is strategizing, and he's got certain techniques whereby he's hoping to take Mueller down, and it's hard to know what way it will go. I think it just speaks to the complete dysfunction that you see at the heart of government and the heart of the U.S. political system, and the U.S. is just, it's civil war politics, and it creates real risk to just the management of the country, and meanwhile, it's like Rome, the empire, Nero fiddled while Rome burned. The U.S. fiscally, they talk about this economic recovery, which is based on just a massive increase in debt, and I think they're heading towards 22 trillion nominal debt, and obviously there's another 100 to 200 trillion in unfunded liabilities.
Wow. And
the baby boomers are retiring, and that's not even in the narrative because they're engaged in this. Trump is tweeting and he's attacking people, and it's just it's crazy stuff, and it is end of empire. There's an end of empire feel to it, that it's become so corrupt, and you've got this. Trump resembles one of these crazy Roman emperors, and there was a lot of crazy emperors, and so there's parallels there in history, and it doesn't bode well for the U.S. economy, U.S. Bond market, and indeed the dollar, and it bodes very well for gold.
Yeah, that's the thing. Regardless of what your political persuasion is, when it comes to U.S. politics, and I would not be a fan of Trump in any way, but I kind of think that if there are impeachment proceedings brought against him or whatever, that can only be effectively negative for the US stock market in the short term. And so that could be another thing that's going to trip up this financial markets in 2019. What do you think, Steve?
Sorry, yeah, I was on mute there. It's really interesting. You know, the stock market, as we said before in the previous presentation, is very much driven by passive money. That's kind of like dumb money sitting there. It doesn't really buy and sell on the news. It just kind of buys and holds forevermore. And so it's. I don't know what's going to happen with these events anymore. I don't think the market really operates as it did in the past in terms of discounting news or buying or selling on news impact as much as it did in the past. So it's very unusual. I mean, I would never expect someone like Trump to be elected. I would have expected any one of the 50 headlines that has had to endure and has been party to have toppled any other leader in history. But he seems to be resilient. He's like the Teflon Don. Nothing seems to stick. He has there's investigations in almost every aspect of his life. Almost all of his inner family, his company, his election campaign, and his presidency. So when I look at 2019, yeah, I think the Democrats they have a major problem, because if they do bring this, to do try and impeach him, the belief is that they'll actually suffer politically as well, and it'll create more of a divide. And they maybe have done it too early. They need to do it a little bit closer to 2020, the next presidential election cycle. And so I don't know if it's going to happen in 2019. I think Mueller is probably sitting on an enormous list of explosive charges that can be laid against him, and maybe he'll be taken out very, very quickly and quietly, because the weight of evidence is just so great. But he seems.
So he has a strategy, you think, and there's a reason why he hasn't moved already.
Yeah, I mean, there's something refreshing about him, is that you you kind of know where you stand. He kind of says it like he thinks it is. I think there's a lack of pretense. I don't think he's a great strategist, as people might think. Whereas in previous policy smart pure spin administrations in the past, they would present the facts after the decision was made, and it was really about manipulation and massaging the actual public opinion. He just comes out and calls it like it is, no matter what, and he has this massive amount of I don't know what you might call it, but he can't shock anymore. The news cycle is so appalling. His base will support him no matter what. It's almost like a religion. He's taken over the Republican Party. He's not even a Republican, in the traditional sense. He was a Democrat for years, So he's this kind of this hybrid political animal that's taken over a party of very disgruntled people who are looking for change and looking for less government and more independent, a more independent, individual-minded system where the individual's rights were protected, and so less government. So I look at it actually. If you go back 30,000 feet, and we were talking about this before the start of the podcast, a lot of this comes down to inequality as felt across these Western economies. And we were looking at at a chart there earlier about the inequality, the arc of inequality through the top 0.1% of the.
Have you got that chart there?
I do, yeah. I can share it with you if you wish. It's really interesting, and essentially what we're looking at here. Can you see that?
Yeah.
So what we're seeing here is back in the 1930s, where the top line here, by the way, the blue line is the bottom 90% of the U.S. population's net wealth share, and the red line at the bottom there is the top 0.1% of the world of the population.
0.1% now, not 10%. 0.1.
The top 10% of the top 1%. Yeah.
Wow.
So that the very elite, and you can see that back in the 1930s, where the first circle is, that they enjoyed around 20% wealth share in the economy, and then when that occurred from the 1920s, 1930s, we had the era of populism, where people were very discontent. There was a lot of anxiety out there. They voted accordingly. They voted after kind of for popular characters who had little in the way of political form or.
So when there's a disproportional amount of wealth concentrated at the top, when the top guys have more wealth disproportionately, it creates this unrest. Is that what you're saying?
Dissatisfaction and disengagement over time, and then when somebody comes along who people believe can actually address this inequality, then they vote for them, and then they give an inordinate amount of power to, and then abuses happen, and we get into a very scary place. And you also find this in other countries. It's not just it's a kind of a global phenomena, and then these strong men, go to war with each other, and very, very, very bad things happen. So you can see then, as the chart progressed all the way into the 1980s, there was a widening of this, where the bottom 90%, their wealth share grew all the way up to around 35%. But in the mid 1980s, it started to fall again, and we're actually at a crossing point. And we haven't been here since the 1930s. And so this chart comes from Ray Dalio. He's one of the world's #1 bond fund managers, and he's quite concerned about the arc of history and the rhyme that we have here with historical precedents. And he's very concerned that, and he was saying actually in this fantastic interview, it's on Business Insider, anybody.
So just make one point before you move on. That's actually suggesting so that the bottom 90% currently have 25% of the wealth. But that suggests that the top 10% have 75% of the wealth.
Exactly. Yeah.
That's incredible, isn't it?
It is.
Yeah.
And
I'd say if you had data on it, it's actually if it's the point, you look, it says 0.1%, it's actually 0.01%. There's only, like, if you look at, there's about 50 or 100 people or families in the world that actually have a huge amount of it, and be interested to see, breaking it down, as you said, Dave, looking at the 10%, looking at the 0.01%, but the bottom line is, it's throughout history, I think it's probably the most unequal society that we have ever seen, and it's a great chart. It's very interesting. One thing, it does give central banks a little bit of a free pass, because it's almost blaming the populist politicians for this, and the likes of Trump. But the central banks are at the very root cause of this, and if you look at the, central bank monetary policies in the last 10, 20 years, it's record low interest rates have boosted the asset prices and created these inflated asset markets and property markets and stock markets. And that's, these very wealthy people obviously own assets, and they're asset rich, whereas the majority middle classes, they don't have much assets, so they're lucky if they
it's
have
the idea of trickle down economics, though, isn't it? The idea, you pump money in, and eventually it filters down to the lower levels, but that just doesn't happen.
It doesn't happen. No, it was staying there. Yeah, it's Reagan. It was popularized in the year of Reagan. Yeah, and I mean, it's not totally wrong. I mean, the concept is not bad, but I think what happens in reality is that when you give something to one cohort of society, they first put their house in order, and then they try to maximize the advantage. And what then happens is the rest of the population start to rent the assets of those few people, and they get access to liquidity, they get access to markets, they get access to capital at the expense of everybody else. So I don't think populist leaders created this problem. I think central banks, Mark's right, central banks created it, and populist leaders are the result of. They're the result of this, exactly. So it's.
But this is also,
Obama was a very populist leader, And
but this is also
all the blame is on Trump, and there are huge issues with Trump.
Yeah.
But this is a continuum for the last 20, 30, 40 years on both sides of the house, the Republicans and the Democrats, Labour and Conservative, Tweedledum, Tweedledee. They've all been doing much the same sort of thing,
Yeah.
Sorry, Dave.
Yeah, I was just saying, you got to layer on top of this then the technological factor as well, the advancement in technology, which effectively, if we look at what's happened over the last 10, 15, 20, 50 years, has replaced a lot of the jobs at the lower end of the spectrum. So the bottom 90%, if the bottom 10, 20, 15%, whatever of the workforce, being put out of work as technology advances. And who owns that technology? Well, it's generally the top 10% or the top 1% or the top 0.1%, which is effectively reallocating that cash back to the top. So the trickle down, if it happens, gets sucked back up to the top again.
And you look at the margins of the average S&P 500 company. They've exploded in the last 5 years. I think that traditionally the margin runs 6 to 8%. Now they're hitting up around 20%. So they are absolutely milking at this advantage. They operate in almost, they have they're in oligopolies, I think the term is, and they're rigging the prices for a lot of services. They're making extraordinary profits in the process as well. So we don't have competition. We have a fall off in competition, a fall off in the number of listed companies. It's very difficult to get into and break in and compete with these big behemoths. And they have global coverage now where they didn't before. They were national champions, now they're global champions. Look at Google. 92% of the world's search traffic goes through one company. That's an extraordinary amount of power that they have and the amount of data that they collect. So I think we've actually never been here before. And I'm not saying this time it's different, but it's our traditional model of capitalism is misfiring. I still think it's the best way to get the best out of people, but I think it's been rigged. And I think, Mark, you've talked about before is the whole era of corporatism as well, and how that intersects with government and people's rights, and you can see this in the share of wealth, you know.
No, absolutely, and I think it's corporatism and corporatocracy, and basically, so people don't understand what it is. It's basically governments and corporations and banks working hand in hand, and in effect, they work in unison, and they bail each other out, and they protect each other's interests, and they're huge vested interests that basically run these our respective governments, you know, and this is at the expense of the individual, the family, the small business, and they're getting a raw deal, and you see that clearly in the chart. There's one other factor besides the emergence of technology. You said, Dave, the other factor here is the emergence of this globalized world with the emergence of China from communism, the emergence of India. And so we have the Western worker and the Western, middle class and working classes are now competing in some ways with the Chinese worker, the Indian worker, and we're seeing this rebalancing, you know. In effect, our standards of living were so outsized vis-a-vis these very, very poor people throughout most of the world, mostly in Asia, and now we're seeing their standard of living raise and our standard of living slowly eroded, you know, because we find it very hard to compete with them in terms of, you know, their very, very low salaries and wages, you know.
And can we speak for a few minutes just about the de-dollarization of the global economy and whether you think that's going to continue in 2019?
Yeah, it is. Yeah, it's. I don't only this week. There's news. I think Bloomberg reported how the Chinese U.S. treasuries they've reduced their allocation to U.S. treasuries, and they're doing it very slowly. We saw it in quite a big way with the Russians this year, and people said to me, "Well, this is something we've talked about for years." And people said, "Oh, the Russians would never sell their U.S. treasuries. Why would they do that? They'd be devaluing their holdings, devaluing their dollars." But when you get into a very tense geopolitical situation, as we see between the U.S. and the U.K. versus Russia, these things happen. So the Russians sold nearly all. I think they've sold nearly all their treasuries, something like 80 billion, which is a lot, you know.
Yeah,
and they've been buying gold in quite a big way. So I think the Chinese will be a little bit more careful about how they do it, and they're not going to do it in any sudden manner in the way the Russians had, because they have a much bigger holding, which would actually potentially impact the US bond market, you know. And they don't want to, they have exposure to US in terms of being massively over allocated to US treasuries. So they're going to slowly do it. They're slowly buying gold, as we know. But if the trade wars escalate, you know, again, it's this high stakes brinksmanship. If the trade wars escalate and Trump plays hardball as he has been, and they don't come to some form of, win-win agreement, then, you know, we get into the currency war situation, and then the Chinese could be a little bit more aggressive on that side of things in terms of reducing their allocations to US assets, the US
so
Treasury.
Aggressively selling down their bond holdings.
Yeah, and buying gold in a more aggressive manner as well. You know, they're doing it in a very gradual, quiet way, and they gradually accumulate. But we don't know; they're not declaring it to the market. Whereas the Russians have actually declared it into the IMF, so it's much more transparent. They're signaling what they're doing, almost like saying, "Listen, we're doing this," and they buy their 15, 20 metric tons every single month. You know, and recently in 2018, it's become their gold buying has actually increased. You know, I think that's a trend that's set to continue. And and it's the whole world. It's not just the Russians and the Chinese. I mean, even the Indians and and South Americans, and obviously Venezuela and Argentina. The US, they've pissed off a lot of people with very aggressive foreign policies and economic policies. And many of these emerging markets are now beginning to say, listen, we have to reduce our dependence on the dollar, and they're setting up bilateral trading agreements, and they're trying to support each other in that regard and reduce their dependence on the dollar. And not just the emerging markets, it's also the Europeans are talking about their dependence, and the German foreign minister came out talking about the American abuse of, and I should say American, it's American elites, American financial elites, monetary elites abusing the SWIFT payment system, and the Europeans and the Germans talking about creating their own payment system, so they're not dependent on Wall Street's SWIFT global payment system, which we're all dependent on.
Yeah, and sorry, when we talk about not being as reliant on the US dollar, particularly from a Chinese point of view, I mean, the Chinese are the biggest holders of US debt, which effectively means they are the biggest lenders to the US. So if they start to reduce their reliance on the dollar, it effectively means that they're lending less and less to the US, and the US has a massive budget deficit that it's trying to fund. It has a massive national debt. It has all the unfunded liabilities. Is there a potential for the case over the next couple of years that it is going to be more and more difficult for the US to actually fund those?
Oh, absolutely. We're already seeing it. And the budget deficits have gone up very significantly in recent months, So the question is, who's going to finance it? And I think they're going to have to go back to quantitative easing, and they're going to have to monetize that debt again, So it's QE, I don't know, QE3, QE4, QE5, or whatever QE we're on. But they'll probably come up with some new term. They won't want to call it quantitative easing. They'll come up with some
different spin on it.
Yeah, different spin, some new acronym, and to justify it as we have to do it. Tina, there is no alternative, and maybe there is no alternative, but all paths lead to further printing of currency, and ultimately devaluation of currency and debasement of currency vis-a-vis real money, which is physical gold and indeed physical silver.
Yeah, I mean, 2019, if you look at it, it just seems to be, a big woolly jumper with a lot of loose threads that could be, any one of them could be pulled, whether it's the debt bubble, whether it's stock markets, whether it's quantitative easing, whether it's Brexit, whether it's politically what happens to Trump in the US. I mean, there just seems to be so many different ways that this thing can really hit the skids, isn't there?
It's I mean, I think we were talking about this the other day. You do a 360 analysis, and you see where's the bright spots out there.
Yeah.
Where's the good news? Like, okay, look at it, on a political basis.
And I suppose you have to kind of preface this or frame this and saying, like, okay, is that just because you're in the gold market that you look at things this way, or is that just because you're in the gold market that you see things this way?
I think there's part of it. We do deal with people's problems, and they come to us and they buy gold because they're worried about something. So we get a lot of those kind of insights from people, but that's not just to invalidate them as well. And you have to test, and you have to, me personally, I look at the other side of the coin as much as possible, and I challenge myself every time I can. And we all have a set of biases, naturally. Some of us live in some echo chambers as well. But when you do look around on a 360 basis, and you look at the political, you look at the economic, you look at the social, the world's in a pretty sketchy place. There's quite a lot on the horizon to be worried about. And I actually think the concept of personal sovereignty is very, very important, and it starts with education. It starts with equipping yourself with knowledge, with having good sources of information, and asking the right kind of questions, and structuring your life around your concerns and around also your strengths.
But I think it also, if I could just jump in here, I think it also starts with listening to people whose opinions you don't necessarily agree with.
Yeah,
because a lot of times we can get people, whether it's listening to our podcasts and our videos, thinking that, okay, well, they're not they're not in agreement with me, so I'm not going to listen to it, or I'm not going to watch it. It's very important. They're actually the
you
time.
sell gold, so you would say that.
Yeah. But these are the market is made up of all of us, and it's important to understand the viewpoints of those that hold different views to us in order to get a better appreciation of the ebb and flow of the market, of the push and pull factors in the market.
Buyers and sellers, absolutely. Yeah. And Steve said about the echo chamber, and there's a risk, sometimes, and we've been doing this 14, 15 years, and we do tend to look at the risk side because we sell a form of insurance, so if you're a car insurance salesman, you're going to know the data on car crashes, and if you sell health insurance, you're going to know about people's health outcomes. So we know about financial and monetary history, and we know the risks that are there, but we're not telling people, listen, buy gold, you're going to get rich. We're not telling people put all your money in gold. We actually very much have always put clients' interests at heart, and we'll actually tell people, listen, if you're about speculating on gold and you think you're going to get rich in it, this is talking to us.
I said that yesterday.
Yeah, exactly.
I said that yesterday to a client.
We're talking about an asset allocation. We're talking about diversification, which is what the financial advisors, the better ones, talk about, and they get what we do, including Ray Dalio and all these big hedge fund managers who all understand having an allocation to gold, not having all your eggs in one basket. It's very simple stuff. Sorry, Steve.
No, I said that to a client yesterday. They contacted me and they said, listen, how much are we going to put in gold? And we've put an order in. Well, let's put a bit more in, and they're looking to ride that wave because there's a bit of concern about the broader markets, and they think gold's going to go up in price in the short term. And I said, well, it's not about making money and going all in on something like gold. It's about actually, having the right amount that gives the right amount of protection. It's about not losing your money and not losing all your money. So it's a return of your capital, and that's really the case for gold. It's a long-term hedge. It's a foundational asset for a portfolio, and if it drops in value, that's actually a good outcome long-term, because the rest of your assets are probably doing very well if it's like 10 or 20%. So if you have 10% in gold and 90% in everything else in investments, traditional investments, then that's a good allocation over time.
Yeah, we hope we're wrong. We hope we're wrong about these risks, because if we're right, it impacts all our friends, our family, all our loved ones. It's in nobody's interest to have an absolute crash, and our Armageddon, like we're doom and gloom. We're hoping for this doom and gloom, Obviously, uncertainty is good for us. We want the gold price to go up because it tends to help us, because people unfortunately tend to buy when the gold price has gone up. They should be buying when the gold price is weak. And we tell them, listen, buy on the dip, buy now while it's weak, not when it's in the headlines again and everybody's talking about it at the dinner parties in 6-12 months time, So, it's just about diversification. And we hope for the best, but we also always think it's important to be prepared for these less benign scenarios that are out there.
Mark, you actually said something interesting this morning. Sorry, Dave. You talked about some stock market experts were on the radio, and what were they saying that you heard?
Oh, it's funny. The same guys were on a year ago, and a year ago they said, "Oh, the outlook for stocks is great; they're going to go higher." And then 6 months ago they said, "Oh, well, stocks have fallen, but we're not going to have a bear market." And now today they said, "Oh, yeah, we're in a bear market. And stocks have fallen. There's great value. You should buy." And these guys are what's called permabulls, and they always tell their clients to buy. And they don't tell them, listen, potentially reduce your allocations at certain times, potentially increase your allocations at certain times, And then they're saying, some guys are saying, "Well, I actually think there's great value with U.S. stocks now. U.S. stocks are the place to be." And another guy would say, "Well, I think European stocks are the way to go." And then the girl doing commercial property said, "Well, don't buy commercial property in this business district, but buy it over here." And it's like, come on, all these assets are ultimately correlated, as we saw during the financial crisis, And okay, there may be a little bit more value in one sector versus another sector, absolutely. But what they're not acknowledging is the elephant in the room, which is Brexit and Trump and all the things that we talk about, because we think they're real factors that will impact the financial markets as they did in 2008.
Now, before I ask you the last question, guys, one thing I wanted, we talk about gold a lot, and sometimes we forget to mention silver, and an awful lot of our viewers and listeners are very interested in the silver market. What does this mean for the silver market for 2019?
Do you want me to take that, Steve? Yeah. Well, I mean, silver is a precious metal akin to gold. It's slightly different in that it has more commodity aspects to it than monetary aspects. It's not quite the safe haven that gold is, but it is a safe haven in its own way. And it tends to react when gold goes up by 1 or 2%, it tends to go by 3 or 4%. Conversely, when gold falls 1 or 2%, silver will fall by 3 or 4%. So it is more volatile, but we've long said that silver, you should have silver as part of the diversified portfolio, but just for most people, you should have a smaller allocation of silver. So you could have, if you're going to put 10% of your portfolio in gold, you could have 8% in gold and 2-3% in silver. And I think in the current climate, I think you should have higher allocations. We get a lot of people, clients giving out to us and comments at YouTube saying, today, given these risks, you should have 50% in precious metals. I'm not sure if you should have that amount of precious metals, but you should consider having higher than, I think, 10%. So if you had 20% in precious metals, you could have 15% in gold, you could have 4% in silver, you could have 1% in platinum, palladium, and that way you're nicely diversified when the precious metals component of the portfolio. Silver tends to outperform gold. It's more volatile. It tends to be for people who are more about making a return rather than solely protection. So it tends to be younger people and people with more of a risk appetite. But it depends. If you're totally risk averse and you're just buying for safe haven reasons, and you get nervous about markets, then you probably shouldn't be buying silver. But the outlook, basically, so that's the reason why you would have silver in a portfolio. Price-wise, it's massively undervalued, and we're below $15, 13 euros, 11 pounds. Roughly, and I think most analysts around the world look at silver, and the fundamentals, the supply demand of silver are very, very bullish indeed. And I think most analysts in the precious metal market look at it and think $20 in 2019 is quite a reasonable scenario. It's 30% gain in silver, and longer term, I think $50 per ounce, 40 euros per ounce. I think it will go back to the prices we saw in 2011 in the next 2-3 years.
Yeah, one thing that we haven't mentioned here, and this time last year when we were doing our very first podcast, it didn't just dominate a lot of our discussion, but it was also dominating every headline, every financial headline, and that was cryptocurrencies and Bitcoin. They were heading this time last year, they're heading up towards nearly 20,000, and we've seen since then them crash off well below 4,000 down to nearly $3,000 dollars. Has Bitcoin, has it had its day, or what do we think about it for 2019? Does it have a role in a portfolio? We talked recently about its safe haven status or lack of, but what does 2019 hold for Bitcoin?
Yeah, I think it's a really unusual one, because I think the people who make up the Bitcoin marketplace are still very much spec heavy, as opposed to traditional users of a currency. So you have to ask yourself, what is Bitcoin? Is it a way of getting a massive capital return, or is it a way of buying and selling things much more efficiently than you could with traditional currencies? I think it's still a massive spec bet, and everything is, ever since it entered the futures market, it's been absolutely, what do they call it? Monkey hammered. It's been slammed and slammed again. So I would think that there's probably some speculative opportunities there if that's what you do as a trader. But I wouldn't go near it on a fundamental basis, not for some time. Perhaps if we have a massive currency crisis, a dollar crisis or something like that, then you might see people moving out of traditional currency roles into something like cryptocurrencies. Maybe Ethereum or all these other cryptocurrencies might be the ones that will garner more support, because they seem to be a little bit more sophisticated. Bitcoin was the first one out of the gate, and it's got a few warts, and it's got some issues around it. It's also got a number of unsavory characters who use it, because of the supposed anonymity it brings. But it's I think I don't think 2019 is going to necessarily be a Bitcoin year. I think it'll move around. It might go up to 6,000, 8,000, drop down again, move around and grab a few headlines. Just on the silver, if I could get back to the silver a little bit, one of the things about silver, Mark, which you've spoken about in the past, is the gold-silver ratio. Traditionally, it's around 15 to 1, 16 to 1. At that means that silver relative to gold should be, let me just see here, around $207 an ounce. It's at 14.38 right now. It's kicking on almost 90 times ratio now. It's at 87. So it's incredible what's happened to silver.
They're all-time record high in terms of that, right? So absolutely, yeah. So silver is great value relative to gold, and gold's good value relative to other assets. So it just shows you how undervalued silver is.
Yeah. So if you've got a bit of money and you're looking at Bitcoin to make it, to make a bit of a return, I'd actually steer you towards silver. It might surprise you and do an awful lot better.
But absolutely, yeah. And then you have a genuine hedging safe haven asset, and you have the option of a very good return. Yeah.
Exactly, but it's also it's got forum, it's got there's good data there to support it, and I think if with you'll get a lot of volatility with it, and it'll move around a lot, so you have to be prepared for that. We tell clients, listen, if you buy silver today, you got to be comfortable with the fact that it might be worth less in a year's time, and this is a long-term bet. It's a speculative bet, but it's long-term. So yeah, I think silver is a very interesting thing.
Okay, gents, I just want to wrap this up. And the last question that I'm going to ask you, and I'll come to you, Mark. If we look back at 2007, if we look back at the last big financial crash, the thing that was one of the sparks that lit the fire for it was Lehman Brothers, and in particularly there was a couple of money market funds that started going a bit dodgy, and Bear Stearns as well.
Breaking the book.
Yeah, so what do you think 2019 is, if you were to pick one catalyst for this? What do you think the most likely catalyst is going to be?
Well, again, I don't know if it will happen in 2019, but I think we're going to move closer to it. And I think it's a question of when rather than if. So it could be in 2020, 2021. But if it was in 2019, it's funny, 6 months ago, I probably would have said Deutsche Bank because I thought it was very underplayed risk. But it looks like the German government is getting on top of that, and there's a forced merger there between Commerzbank and Deutsche Bank. At the same time, Commerzbank has its own issues, so it's still a real risk there, The Italian banks, I think, is a very underestimated risk. And then obviously you've got the Italian sovereign issue in terms of the politics of Italy and the rise of the right and the left there. And I think you're going to see these elections. The big thing to look, I think, because we talked about Brexit, but one thing we haven't talked about is we've got European elections in May. And I think all the stuff we've talked about in terms of populism and inequality and all the frustrations that there are with the political and financial monetary elites, we're going to see them writ large in these elections in May, and you could see a lot of anti-EU and anti-Euro politicians elected throughout the European Union, and then you're going to heighten the risk of separatist movements throughout the EU, and I think that the penny will drop that the whole EU project is not sustainable.
Steve?
Yeah, I mean, I think Brexit will be a damp squib. It'll be a very boring affair because it's the first one out and people don't know what to expect. So they're kind of sitting on their hands, and it'll limp over the line in some ugly format. But I think Italy is the actual one to watch. It might be beyond 2019, maybe 2020 or something like that. But I do think as interest rates rise, the burden of massive debt will find them out, and they don't have the political cohesion to manage a crisis. They don't have the relationship with Europe to bail them out, and I think the idea of an exit version 2.0 might be attractive to them, and so I think Italy is going to be the big crisis, and they have an inordinate amount of debt. It's incredible, and as their debt that has everything you need for a kind of a contagion crisis. You could find that then permeating in Asia as well, and where their debt is quite high as well. So I think it's going to be an Italy match that will light the fire.
Yeah, and it comes a time when Mario Draghi, the Italian central banker, or I suppose he more accurately called the Goldman Sachs central banker, is retiring as well. And there's talk that the Germans are going to assert their muscle within the ECB and the Bundesbank. Jens Weidmann is one of the potential candidates who's quite hawkish, So I think it's going to be interesting. I don't think there will be an appetite to bail out. I don't like that term, but to monetize the Italian debt and to help out the Italians, these politicians, if they decide that they think that the ECB is going to monetize their debt. I'm not sure. It's going to be very interesting. Let's put it that way.
Yeah. So it's a real case, as you say, guys, as hope for the best but prepare for the worst. And we're going to look with interest to see what 2019 holds for financial markets. But for now, on this podcast, we just want to say Happy New Year from myself and from Mark and from Steve. And just remind everybody that you can subscribe to our podcasts on iTunes, on SoundCloud, and on YouTube, and hit that notification bell so that you get notified every time that we release a new video. And you can also stay up to date with all precious metals market news by registering for our and subscribing for our market update on goldcore.com. But for now, once again, it's bye-bye and a Happy New Year to everybody. Good luck.
Happy New Year.
Yeah, Happy New Year, everyone, and thank you so much for all your support over the years. Do feel free to give us a call to discuss any of the issues we've spoken about today. Take care.
Absolutely. Thank you. Take care. Bye-bye.
You're listening to the Goldnomics podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed.